All right. It's snowy, cold aftermath here in New York. Welcome to the Big Skinny with me, Lou Basenese, your host with the most, where we like to bring you all filling, zero fluff, and all the things that matter in the investment world today. Some people call us the sports center of financial news, and we'll take it because we give you the highlights. Each show, at the top of the show, we give you our rundown where we tell you one headline that you should most likely ignore. We give you one data point that you really need to pay attention to because it's telling you the real story behind the moves in the markets. And then we don't leave you hanging. We tell you one investment move to make because let's be honest, folks, if we don't show you how to make money and we don't make money together, we won't be hanging out much longer. So that's our take on everything. This show, we're going through our top 6 predictions and then some for 2026. You might say it's a little late in the year, but I disagree. You've been overwhelmed with predictions since December. Now all that chatter is settling down, and it really makes sense to focus on what's already working this year and what we expect to keep working. So with that being said, let's get right to it. This week's rundown, but please don't be afraid to join the conversation. We are live streaming on X and YouTube, and you can make this a choose your own adventure show if you so choose. Opine with some questions, some stock tickers for us to look at, fire back on our predictions, tell us we're stupid, tell we're geniuses, whatever you're feeling, we're here to respond in real time, no filter, no fluff, all filling. So with that said, now let's get to this week's rundown. Funny phenomenon in the markets when you have 2+ years of double-digit gains for the S&P 500. The financial media just can't find it in their souls to be positive anymore. They just have to be Debbie Downers. Barron's taking the cake this year, saying that this headline that it's really not going to be much reason to celebrate for stocks, which is funny because stocks are rip-roaring in a bull market. And they've continued to go up, and all the indicators are they're going to keep going up, and we're up and to the right already heading into this year in most sectors. But again, this is a thing. Yogi Berra said it best. It's tough to make predictions, especially about the future. That's true, but what else are we going to do? We got to pontificate and prognosticate about what might be ahead so we know where to put our money to work. I'm actually going to shock myself today. I'm going to show you the prediction of someone that I pretty much universally completely disagree with, but I think she's dead right on this. I'm talking about none other than Cathie Wood, the incinerator of innovation capital. If you've ever looked at any of her ETFs, she's got a great marketing machine, but not a great track record. She's actually had terrible performance, but still keeps raising capital after dollar after dollar. But she's spot on here. She says basically in short order that she thinks the next 3 years could rival the Reaganomics-era on steroids. In fact, it could be a golden age for U.S. equity markets. She remembers this back early in her career where it was a combination: deregulation, tax cuts, sound monetary policy. I don't know if we got that. And peace through strength sent the dollar soaring. Well, this put a lid on the gold price. I don't know that we got to put a lid on gold price this week, but I will give her this. I think we are indeed on the cusp of a golden age for equities. The Fed's going to run it hot. The president wants lower interest rates. The economy's rip-roaring. The latest Atlanta Fed data suggests a Q4 GDP print of over almost 5.5%. I think 5.4% was the last estimate that I saw. So we are indeed in the golden age. So how do we go about this? I mean, Peter Lynch had this, I shared this quote in our last episode that basically everyone on Wall Street has every imaginable indicator at their disposal, and yet they still suck at making predictions. I'm going to teach you one thing that you can predict always and always be right, and it has to do with earnings. You're going to get tired of me saying it if you're a longtime listener to the Big Skinny, but stock prices ultimately follow earnings. So as long as earnings are going up, you can boldly and confidently predict that stock markets are going to go up. And look, lo and behold, S&P 500 earnings for 2025, 2026, and estimates for 2027 call for nothing but more increases in earnings. Now, I've shared this on previous shows and in recent media appearances. Analysts have been woefully too conservative about how fast earnings are growing. If you look at the last 4 quarters, they've estimated only about 6 to 7% earnings growth for the S&P 500. And every single time it's checked in over double digits, 10% or more. We've got a few quarters of 14%, 15%. And folks, this isn't just the Mag 7 companies driving this. It's the entire market. You're seeing that happen as this bull market gets longer in the tooth, that the other unmagnificent 493 are boosting their earnings too. And here's the key. I said it to you multiple times. I mean, you're going to get sick of it. It's going to be parental advice that you don't want to listen to. But 10 years from now, you're going to know that guy, Lou Basenese, told me this too many times, and he's right. If you look at earnings go up, guess what moves the stock price? And more so. Over 2023, 24, 25, we went from the stock price return in the S&P 500 being driven by about 30% earnings growth to now 55%, and to last year, 80% of the return in the S&P 500 had to do with earnings growth. It wasn't because stocks were getting too darn expensive, because multiples were getting too high, right? So it wasn't that investors were bidding up and paying more and more for the same amount of earnings. No, in fact, the opposite was true. They were saying, we're going to be disciplined. We're not going to overpay for earnings growth. So the earnings better keep growing and we'll still pay the same multiple. So folks, with that being said, it's really easy. The stock prices are going to go higher this year. Don't miss this bull market. You got to own U.S. stocks. I saw a headline again today, keeps coming back up like cockroaches. You can't kill these headlines that say you should get out of U.S. stocks. It's anything but the USA for equity markets in 2026. That's a bullshit, as we've said here multiple times. There you go, my friend. Well timed, boys in the studio. So you've got to own U.S. stocks. You can't, it's like the lottery, right? You can't win it unless you're in it. You can't look back and go, man, I wish I would have known that stocks were going up. You don't need to be that negligent. You have all the evidence in front of you telling you that this stock market is going to rip even higher than it has in the last 2 years, because earnings growth is accelerating. The U.S. economy is accelerating. Tax cuts are kicking in. Deregulation is kicking in. And look, we've got a president in charge that is adamant about driving down interest rates, which is going to run this hot. You got to own assets. So we're going to tell you after this quick break, and after you follow us on socials. But first, let's remember this. Don't think it's too late. Don't think you have too little invested in the market, because this chart really drives home the point that the little guys and gals are winning the most since 2010, right? You hear all the time about the top 1% and the equity divide and how it's just widening. But I got to tell you, the bottom 50% has done pretty darn good as long as they're invested in the market. You see this here, comparing the wealth accumulation by household stratified based upon whether you're in the top 1%, the next 9%, etc. The bottom 50% enjoying a 1,195% increase since 2010. But again, you got to own assets. If you don't own stocks, if you don't own any assets, you don't get that appreciation. So it's our endeavor here to make sure you're in the markets. And to do that, we got to make sure we give you specific investments, which we're going to spend the rest of the show doing, telling you the 6 or so trends that we think are going to be big money winners for you and how to play them. We got our first live interaction here. Lou, you should make a meme coin since everyone else is doing it. Would be funny. Yet the ex-mayor of New York City had a 2-day meme coin, and I think he collected about $3 million. I mean, look, if you help me pull it off and we're going to split the money, I'm in on it, man. But actually, no, I'm not into rug pulling people, conning them out of their money. Let's make it the good old-fashioned way. Let's find the right trends in the right area of the market that deliver above average gains for us. And we're going to come back from this short break and do just that. Start elucidating those areas of the market where there's the best opportunity as we go into February and the rest of this year. So stick with us. We'll be right back.
Lou Basenese with me for the hour to cover these markets. Are analysts too conservative?
They are. They should follow that Mark Twain adage. It's better to keep your mouth shut and be thought a fool than open it and remove any doubt. Because I tell you, for 3 quarters in a row, by my tracking, they've been underestimating earnings growth by at least 30 to 40%, expecting 5 or 6% growth, and then S&P 500 companies post 10% plus. So this quarter, they only expect 8.3% growth. I think we get another double-digit growth, which drives this market higher. This is the key fundamental about predicting where stock prices and the markets are going. It's earnings growth, and it's never been better. I mean, you're talking about optimism is back. It's back for these companies. It needs to get back there for these analysts. They're too conservative.
All right, welcome back to the Big Skinny, where we are going through our top 6 bold, big predictions for 2026 in the market. And you know what? you're going to get really tired of hearing a monologue from Lou Basenese if I go the rest of the show all alone. So I'm going to bring in my partner in crime, the fearless Main Street investor, the Dodd man. Welcome back, my friend. Been a few weeks.
Been a few weeks. Good to be back, Lou. And
No.
I have to jump right in and say something.
What? You can't do that. This is the Big Skinny with Lou Basenese, not Dodd show.
Well, we'll get there. We listen to our audience here, and it sounds like somebody wanted us to make a meme coin. Maybe we'd start by bringing back a couple games about meme coins, and we do stuff like that. And maybe we'll get there. What do you think?
I think maybe, and I think that would make one person on this split screen really happy. Yeah. So check in with Matt Walliver. Is that small biotech M&A?
Matt
this
wants
the
a
year?
Meme coin, and I'm down to brainstorm. Let's just say that. But
yeah, I'm down with what Jason A has got going on here. Is it the year for small cap M&A? Names to watch. Absolutely. We can rattle off a few names for you right now. Gain Therapeutics, Koya Therapeutics, Actuate, let's see, that's at least three right off the top of my head. But we're going to get into that and more because that is actually one of our predictions that biotech is going to keep having a comeback. So you want to kick us off? What's our big prediction? You got any predictions for this year, Dodd?
Well, staying on topic, seeing that I took us right off topic out of the gate, I think our first prediction is oil to $75. So,
which sounded crazy a couple weeks ago when we were sharing that with some of the guys that I'm a regular contributor on media with, as we were going around the horn sharing our top stock picks. And I, in fact, shared an energy and oil company one. But in the last 6-7 days, what did natural gas do? Does anyone know? Yeah, it's up 105%. So saying that commodity prices can't move quickly and massively and severely is now just been proven right. So yeah, look, oil north of 75, that's really not that big of a move from here. I think we're at 60, 61 bucks. So maybe we need to be bolder. Maybe we need to say oil at 95, but I don't want oil at 95. That's getting a little too expensive.
Now, do you think the quick increase has to do with the weather conditions going around the country? Obviously, that's a spark to that. How much is that volatile? Is it a volatile thing, or is that like an actual indicator of it's undervalued and it's just there's upward from here?
Yes, and yes. So it's basically yes, it's because of weather, short-term weather impact, but it's also a structural problem with supply. If we had abundant supplies and weren't shipping every last bit of natural gas that we had over to Europe, we'd be able to settle this and make up the gap. But that's what you're seeing, is because it's such a supply constrained market that when demand goes up or gets cut off, that you see this massive increase in price, which I think you can see with oil as well, right? You see a lot of companies that are backing down from production. Actually, we've hit peak production. Estimates now for 2027 are going down for the Permian Basin, the most prolific oil producing basin in the US. But here's an interesting thing. Go ahead, everyone at home on your own screens, and go into your search engine and pull up the sector performance for the S&P 500 year to date so far. We're 26 days into this first month of the year, and guess what is doing the best? Energy. I mean, it's outrunning materials, every other sector out there, and not by a little bit. I mean, we're talking almost a 10% move in the first month of the year. So lo and behold, everyone is negative. Everyone is bearish on oil, yet the energy sector is rallying. Part of that is natural gas, but part of it is the Venezuelan invasion. But another part of that is it just got too darn cheap. You looked at earnings estimates and the valuations in the energy sector. They were the lowest in the entire market at about 15 times earnings. The weighting in the S&P 500 was the lowest it's been. I mean, the classic contrarian setup, which is why I think this prediction sounds bold, especially when JP Morgan and Goldman Sachs are out there saying we're headed for $30 to $40 barrels of oil this year. It sounds bold, but it's really not. Short positioning is at a record high, the biggest we've seen in 10 years. I mean, this is just a classic. When everyone thinks alike, everyone is likely to be wrong. Yes, WTI to 80. Bring just that. All right, Chad, we're getting it to 80. We're bumping our estimate from 75 to 80. We'll change our graphics from here on out. Let's go oil to 80. Join the conversation. Let us know what you think of our bold predictions. Energy, we're starting off with probably the most hated asset in the market right now that's showing signs of life. Don't let this be the time that you go, man, I should have listened to those guys. Things were moving and I missed.
It's a little bit ironic, I think, that, the most hated asset, when you're talking like, crude oil or coal or whatnot, it's thriving right now. I mean, the country's depending upon it, with this weather. I mean, that's what they're leading on. I think what I heard 40% of the keeping, the Americans warm right now
Yeah.
is coal and oil and natural gas.
Yes, fossil fuels, everything, folks. Don't you forget that. I mean, it's kind of hard to have power being generated from solar panels or turbines when they're covered in ice and can't move, or there's no sun out. So that's the problem with intermittent power sources. Yeah, they're nice to have when you've got those abundant supplies of wind or available sunshine. But you need to have baseload power from coal, natural gas. Really, you don't want to be burning oil to generate electricity. It's super expensive. But you pointed it out, we've had to in multiple states through this winter storm because it's what we have available, and you need the power, right? I mean, the alternative is shut down and have power outages, which doesn't make anything better. It actually makes it a lot worse, and you just snowball from there. No pun intended.
And it reminds me of a great famous quote by Mike Tyson of everybody has a plan until you get punched in the face. So, you get punched in the face with a winter storm that is, one of the decades, everybody leans on what they need to, right?
Yeah, I'm glad you went there because I thought you were going to go Alanis Morissette when you said it's a little bit ironic earlier on. I was going to get mad at you. But here's the key chart, right? So, no, I know. Energy is going higher from here. How do we play it? I always say the easiest way to put your toe in the water, the cold water, frigid water of hated asset classes is with an ETF. Buy the XLE. It's the Spider Energy Sector ETF. Gives you exposure to 23 different energy companies, the biggest and best in the country. It's an easy way to play that 10% rally that's already happened in January. It could go much higher. But here's the key thing to realize. Commodities are driven simply by supply and demand, right? The cure for low commodity prices is low commodity prices because the providers of it stop providing as much supplies, which if demand stays the same, supplies go down, it means prices are going to go up. And this is exactly what this chart shows. Most people think the Permian Basin in the US is just endless oil. We've got 500 years of reserves. Not the case. At under $60 a barrel and under $50 a barrel, we have about maybe a year's worth of drilling activity left. That's it. That's it. So if you told me today that a year from now we're going to have no new oil coming online, I'd tell you we're going to have a huge supply crunch, which is going to lead to a massive increase in price. And folks, that's exactly what we're staring at. That's why no one wants to go to Venezuela, because that oil is actually really ridiculously hard to process. It's heavy, sour. It's like pavement before it settles, right? I mean, it's that thick, high in sulfur content. It commands a discount of about $7 to $12. So no one wants it because the economics aren't there. And if businesses can't make money, whether you're in the oil business or the grocery business, you don't stay in business. You don't keep doing that, things that are unprofitable. So that's the situation we're staring down at. Current oil prices gives me the conviction that, yep, earnings are headed higher and so are energy prices heading out through this year.
It just seems crazy that oil is in the most crowded trade on the planet, with the limited supply and the great need. But.
Yeah, I think, look, Landman is doing a great social justice by that series is really educating people into how pervasive our use of fossil fuels are. 75% of everything we do each day is based upon fossil fuels. The clothes you wear to the electronics that you use, everything. Yeah. So like it or not, you can be out there protesting about an energy transition, but more than not, you're actually subsidizing fossil fuels with all the material spending you're doing and using to make those protests happen. So moving on to prediction number 2. I can't remember. Are we talking small caps next? What did we say?
Small cap outperformance with little Lou. I mean, mini me.
Yeah, mini me that has no hair. So that can't be me. I got a full head of hair still. Look. That's funny. I know. It's a little bit ironic, Atlantis.
You're bringing up Alanis Morissette. What are you doing?
You put it in my head, dude. So here's the thing. I've been banging the table for small caps to outperform large caps for way too long. I've been, as I like to say, that I've been early, and that has the same number of letters as wrong, but now I'm right. If you look at the latest performance in the last 3 to 4 months of small caps, and then the last 14 days in particular, small caps have outperformed large caps. We're coming off of one of the longest streaks where large caps have outperformed small caps. What we've seen after that, after these long stretches where large caps outperform and small caps underperform, is 6 years of small cap outperformance. So the slingshot goes all the other way in the completely other direction and launches small caps straight up into the stratosphere. We saw this coming off the COVID bottoms. I don't know if you remember this, but we saw small caps and micro caps rise about 140 to 180% in the 3 months off the COVID bottoms in February of 2020. where large caps were up, a solid 100% or about 80%. But small and micro caps did way better. I think that's what we're setting up for right here, right now in 2026 for a multitude of reasons. Small caps, most of them have 100% exposure to the United States, right? So they're domestically focused, whereas large caps, about 40% of revenue comes from overseas, so international customers. So you got a GDP in the US that is going to probably top 5% for the full year. We don't have that. You see interest rates are going down. So small caps that use a lot of higher rate financing and debt financing, they're going to get more affordable financing. And add it all up, anchor it back to the beginning of the show. Dodd is definitely sick of me saying stock prices ultimately follow earnings. But look at this flip that we see here. It's just the orange bar. That's all you got to pay attention to. The black is large caps, earnings growth, 5-year average.
That's blue. That's blue. Remember, we talked about this.
That's dark blue. It's dark blue from designer Dodd. Dark blue, 11% earnings growth, 5-year average for large caps, 7.9 for small caps. But look at what is the estimate for 2026. Nearly double the earnings growth rate for small caps. Now, you're seeing a lot of small cap companies that were unprofitable flip to profitable. We talked about that in recent weeks, how 40% of the Russell 2000 was unprofitable about a year ago. Now it's down to 25% and going lower. But folks, the breakout is happening in small caps. Again, best way to play it, if you don't know what to own, is the ETF. The IWM gives you exposure to the 2,000 best small caps in the country. It's an easy way to play this trend for double-digit gains as they move off these market lows. And, remember, small caps just hit a fresh all-time high maybe a month or two ago, the first one in 4 years, whereas the S&P 500 and NASDAQ and large caps have been hitting new all-time highs, ad nauseum. So you see this base building coming off the temper tantrum, the tariff tantrum there, and being going up and to the right and hitting new all-time highs. So I think this trend continues well into 2026 on the heels of earnings growth for small caps. We, most of the time, give you investment ideas that are in the small cap space. So if you want individual stock ideas in the small cap space, we're going to be the source for them moving forward because that's what we focus on. But at the very least, go into your 401k, tactically over allocate to the small cap fund or the micro cap fund. If you're a little bit of a nervous Nelly, you can do it in the small cap value fund and you'll still do really well, is my estimate. That's not personal financial advice. That is Lou talking to himself if I had to go log into my 401k right now and adjust my allocation.
All right, now I'm going to ask you a very Dodd question, which is obviously retail investor focused. So, with the small caps, for me as a retail investor in that way, they're definitely, better priced. We've talked about this on shows before and in the past, large cap stocks, higher priced, how important do you think is that with the resurgence of retail investing and small caps being where they are? Do you think that this prediction, as far as what we're saying, how important is that?
Yeah, I think price, it's a psychological thing, right? Even if you're paying $100 a share or $1,000 a share, but you're still getting, a stock that's trading at 15 times earning. It's what's heavier, 1,000 pounds of ice cubes or 1,000 pounds of feathers?
1,000 pounds of feathers.
No,
just kidding.
They're the same,
That's a
right?
good question. I know your answer.
Yeah. So, I mean, it's a psychological reality because that's why companies like NVDA and Tesla, they do stock splits to bring that price down so that, no one likes buying one share, right? Like a stock like Warren Buffett, none of us can afford one share of Berkshire Hathaway, right? It was over hundreds of thousands of dollars, right? Mm-hmm. Everyone likes to know, like, I got 1,000 shares or 10,000 shares of something. Or my brother-in-law told me to buy this tiny penny stock that was trading for 3 cents, and I have 400,000 shares. Or when we're talking about crypto coins. Remember when I bought Bonk Coin and bought 29 million Bonk coins? And spent a whopping...
I can't believe you just admitted that out loud.
And spent a whopping, I don't know, I think it was like $600 to buy 29 million Bonk coins because they were trading for a fraction of a penny. And I was like, hey, man, if this thing moves 2%, we're going to have,
$100 goes a long way with a Bonk coin.
That's right.
No, but that's a great point because, again, in my brain, in my mind, I look at that. And what you just described is a lot what I think. And, just you and I talk, and we've always, you've always said that. It's like, it's not about the cost of the stock. It's there's other factors involved. To your point, what's
Yeah.
1,000 pounds of feathers versus 1,000 pounds of whatever.
Listen, if we have $1,000, is this live? I don't know. Gecko, are you live? Are we in a simulation? Is this the Matrix? Where are we? Yeah. Do you have a question? That's the next question for you. Yes, we're live. What can we answer for you? Let me bring my magic 8-ball and shake it. No, look, I mean, this is the thing. We're trying to, I mean, at the very base, right? Stocks ultimately follow earnings, and we're trying to take $1,000 or $10,000 or $100,000 and make more money out of that, right? Who cares what we buy with it in terms of what the price is, right? You just, I mean, the price needs to be right? It needs to be undervalued and can sell it for a higher price down the road. So, no, great question, man. It's the psychology that definitely plays in to these markets. Small caps definitely benefit from the fact that a lot of them trade for under $10. I mean, there's just a great feeling psychologically when you're like, man, I'm buying the stock for under $10 and it could go to 100, and I have a 10 bagger and I got a few thousand shares for not a lot of money.
Yep.
Yeah.
All right.
So that being said, don't go all in on small caps. They are the more risky investment. Definitely don't go all in on small cap biotech unless you like pain and punishment before you get rewards, because
that's balanced portfolio. I mean, that's one thing that, we keep hearing and keep saying, it's balanced portfolio. It's making sure that
diversified. We don't want to use balance.
I'm sorry.
Yeah. Balance means 60-40, and that just has not done well. 60% stocks, 40% bonds, but that's for another day.
Diversified. Yes.
Yeah. The Spectre is watching us. Love what you're doing. We love that you're here jumping in. So please do not be shy with future comments as we roll through our next big prediction. Prediction numero 3.
Big IPO busts.
Yeah, this one's not going to be popular, but I'm telling you.
Come on, SpaceX IPO is coming, baby.
Yeah, SpaceX is going to be X-rated for the carnage it causes for all the suckers that run up and try and buy that IPO and get decimated. You heard it here first. I'm not going to make any friends with Elon Musk. He's definitely not going to follow me.
Dude, we're trying to get him to follow us on X. Let's not piss him off.
Here's the thing. I don't bow down to big personalities. I bow down to data. I'm always data driven, so I don't care where the politics fall. If the data points me in that direction, I'm an independent thinker, and we've shown this before. The data on IPOs, the best number crunching that happens on IPOs, I'm going to try and get him on a future show, is Professor Jay Ritter out of my alma mater. I know, go ahead and puke.
Yeah, let's not talk about that.
University of Florida. But he shows long-term performance of IPOs, right? Like the short-term coming out of the gate is not good for individual investors that buy at IPO price or buy in the first day of trading in the markets. It's just not a successful strategy. And lo and behold, you have all these headlines talking about Discord going public, maybe Anthropic and SpaceX. You said it, at a $1.5 trillion valuation. That's the initial valuation. I mean, think about that. 5 years ago, we had one company that traded over $1 trillion value market cap, and that was Apple. Now we have like 6 or 7 that are north of $1 trillion, and you're telling me SpaceX is going to come to market at $1 trillion valuation? Guess what happens? Exactly what you see on this chart. The red is all you need to focus on, right? If you're colorblind, I'm sorry, it's the bottom half of the chart. It's the bottom regions. But if you don't want to dig into the details, it just shows how many IPOs underperform as you go further out, and the majority suck. The performance is terrible if you buy. It's the distribution of IPO returns, and they're not so hot at all. Well, what does that mean? That means don't get caught up in the hoopla when SpaceX goes public, especially if you're an investor, not a trader. If you want to be an idiot and speculate on the first day of trading and get in and try and sell 30 minutes later, that's the greater fool theory and work. Have at it. But I'm telling you, I'm a longer term investor. The odds of you making a successful investment or getting an allocation that's meaningful are next to nothing in IPOs. But here is the good. Here's the catch. These things get their clocks cleaned, and
wait for the pullback. That's
the time to buy, right? There's a 180-day lockup for insiders. That usually precipitates selling, and that's usually the crescendo of selling. Figma's IPO, right, came to public last year. Great tweet by the guy who's like, think about all those employees that were so happy on IPO day, and then over the next 6 months, watch the thing collapse 75%.
They couldn't sell.
Look, exactly. IPO boom and bust happens with regularity on these overpriced, overhyped, over venture backed companies, because this isn't an exit for them. We saw it even with Facebook, right? It was Facebook when it came public. It came public at like $20 or $22 a share, and very quickly went all the way down to about $12 to $13. So if you're a speculator, I would say I would rather wait for the first day pop and try and short these names on that pop down, and then as you hit near bottom, near the 180,
Not financial advice.
Nope, 180-day lockup. This is a general strategy in trading. Then you can look to go long. I mean, Astera Labs, great example of this. What is the classic one? I can't think of it. Another chip maker. That it will come to my mind later on, that we saw the same thing happen, where these stocks just sell off precipitously coming out of the gate in the months that follow. CoreWeave was another one, right? It sold off, then ripped time and time again. So it's not popular. It's going to be an IPO bust year. You're going to see a lot of banners and celebrating it because all these exits for venture capital firms at these ridiculous valuations. But I bet you the performance is going to suck. And that, my friends, is when we're going to get involved, because we're going to go, hey, it's great to be a contrarian because now we get to buy things on the cheap, and we're going to get plenty of those opportunities. We'll go through that. We'll go through the IPO pipeline in an upcoming episode and really run through the strategy of how to trade those and how to find and time the investments when it makes most sense.
Yeah, I saw, there's a lot of content out there, obviously, but I saw somewhere that it was like, people talking about, I'm putting my whole life savings in SpaceX IPO, it's the future and all this. And it's just like,
it's so stupid here. I mean, I hate to say that, but play stupid games, win stupid prizes, because here's the thing. Think about this. From zero, that company, SpaceX, was founded at a $0 valuation, right? It was an idea. It is now going to come public at $1.5 trillion. So that first $1.5 trillion of value has already been created for public. I mean, not for public investors, for private, well-heeled, well-connected investors, including Elon Musk. What we want is to find companies that come to market at really cheap valuations so we can be part of that run up in prices. That the value creation happens in the public markets, not the private markets.
This is hype at its finest.
It is, absolutely. Well said. I got nothing better to say on that one than that. And now we got to tell people to follow us, right? Are you guys actually live?
Is this
that hurt? Yeah,
I don't know if this what's going on here.
Maybe people just don't think anyone goes live. I don't know. Maybe people took too many gummies on the snow day and they're just not sure. The fog's wearing off. But yes, we're live.
I want what he's having. No.
We're live. We're here to take your questions. We're here to respond to anything that's happening in the markets anytime, all hour long. So please do not be afraid to chime in. Don't be afraid to follow us on socials either, right? Mr. Beast can't hate us yet because we haven't said anything negative about him. But I will tell you this: he's genius. He's starting a financial media company. He secured a $250 or $200 million investment from Tom Lee and Bitminer. Really smart move to scale that up. But look, we just want to be a fraction of a fraction of a fraction of his percent as popular as Mr. Beast. So follow us on YouTube, and here's the reason why. We put up a lot of additional videos and insights. The best way to get reminded of our next live show is if you are a subscriber on YouTube. So follow the QR code on your screen or go to YouTube, Lou_Basenese, and subscribe now to our page for the latest reminders. And with that, we're going to take a quick break before we come back with 3 more big predictions and the investments to make based upon them on the Big Skinny with Lou Basenese and Dodd.
So with us now, Fox business contributor Lou Basenese, Executive Vice President at Prairie Market Operating Company, and Dan Greenhouse is here from Solus Alternative Asset Management. I know you're super into this because, Robert Wolf comes on the program a lot, and he likes to say in debate about inflation and prices that electricity costs have gone way up. Well, I ran the numbers because he said it more than once. Robert, if you're listening, here's the numbers for our brain room. Okay, so under President Trump's second term in office, they're up 5 and a fraction of percent. So for rounding sakes, they're up about 6% under this presidency, a single-digit percent. I look back, and over the Biden years, his 4 years in office, electricity prices are up 30%. They were up 30%, 31% under Biden.
In states like California, it was closer to 60 to 70%.
Okay, so for those who are asking about it today, where were they then? But now I'll turn it over to you.
They were on the bandwagon of an energy transition away from everything fossil fuels to everything renewables, wind, solar. And if you look, based upon blue or red state, where they leaned into renewables, electricity prices are much higher in blue states because they relied on more new generation coming from solar. So we may see prices rising now and accelerating, thinking that data centers are the scapegoat and the ones that should be blamed. But it's really the policy and the structural changes that we made in the last 10 years to go away from fossil fuels, away from coal, which is even cleaner than it's ever been now. And we see countries like China embracing it. So I think this is a painkiller that needs to be addressed, not just with price caps and digital impact fees for these big tech companies, but a structural change in how we generate power.
And with those prices start.
All right, we're back on the Big Skinny with Lou Basenese, where lo and behold, we talked about, someone suggested that I create a meme coin. And I think, folks, because we are live, someone has created a meme coin that they're trying to get me to claim, the Lou Basenese coin. Let's raid his post. Yeah, raid it. Go. Come on, get me a crypto attack. This is what I love about the crypto markets. It's, it's a little bit frenzied and frantic. Coin will run once. What do you think of a Lou coin? I think the Lou coin's out there, and it looks, someone tweeted it at me and says it's on bags.fm, as in bagholder.fm. Like, blast the radios. Am I going to be a sucker? Is this a guy from Nigeria that wants me to click on a link because he's got a $21 billion prize that is going to be mine? 6-7. Oh my gosh, who let the kids on here? $100 ready to claim. Folks, gosh, I've always said I don't want to go viral for the wrong reason, but I think maybe, just maybe, I can't remember who made the original comment, is making me go viral because there's a Lou coin. Well, what? Reserve, I'm not going viral for this. I'm here instead of the fast buck or penny or half a penny, the bonk coins of the world. I'm here to actually give you investment advice. Yeah. We made a bags coin for you where you make 100% of the fees. Yeah. 100% of the fees, Dodd. If it sounds too good to be true, it always is. Dodd, I got a proposition. I'm going to bust my ass, work really hard, and give you all the money. How, you in for that? Come on, sign up. Where all you have to do is send me $5,000 right now, and I'll make that happen. It's the setup.
All I want is an apology from you for my "is it crypto or crap" game.
Well, I'm going to tell you right. These guys are going to make me admit that the Lou coin is crap. Because they made, this is like, peak irony, a little bit ironic. This is the theme song of this episode. All right, folks, I will admit my naivete about crypto and how you go so quickly to create a meme coin. I actually had to get educated by Anthony Pompliano and some other smart folks in the world just to get me over the hump on Bitcoin, and a believer in that. Even, I said that was the top two. When Lou Basenese got into Bitcoin, prices were going to roll over, and here we stand with Bitcoin 87,000 today, while gold and silver are ripping towards new highs almost on an hourly basis. But anyway,
if we did a meme coin, could we use mini me as your kind of little icon or logo? Because then that might be kind of cool.
Put my hair on it and I'll let you do it. I'll give you permission.
Love it.
Keep the comments coming because we are live. Crypto or crap, lifetime subscriber. All right, thank you. Yeah, you know what? I told you we'll at least be good sports. So you're giving us a hard time. You're pulling our leg. I'm still not clicking on any damn links to give to bagholders.com. Just take a look. It's actually something worth looking at. This is the kind of how hustles happen, right? Just badger me, keep going. But folks, we got a show to get through. We got 3 more big predictions before I even consider looking at the Lou Bag of Donuts bag holder meme coin that was created in my honor as we are live. Yes, folks, we've been asked multiple times.
I think they're targeting the wrong member of the Big Skinny. Dodd coin you might want to try.
Oh my gosh.
Might not have as much attention, but it might get a look more than you.
Yeah. All right. So next up on our prediction list, I forgot to mention, the last one we covered was an IPO boom and bust, right? Yeah. There's going to be a boom in new issues coming to market. A lot of them are going to bust. How do you trade that? We talked about waiting. Is there, an upfront way? There's an ETF, the IPO, the Renaissance IPO ETF, the ticker is as expected IPO. I don't think it's a great one. It kind of trades sideways. New IPOs are added about 30 days after they come public. So it's not a pure proxy for IPO performance. So great research at that website, IPO Renaissance. They do manage money. Not a knock against them. It's not a perfect way to play the other side of the IPO boom and bust. But
so where you talk about, some other ETFs that are good to, invest in if it's kind of a catch-all. IPOs, no, not so much, is what you're saying.
No, it's too many rules based. I mean, because there's a lot of IPOs. Like, I mean, for instance, go back to 2007, and then even more recently, about 3 or 4 years ago, there was a lot of just Chinese IPOs that had like next to no shareholders that were only doing like $4 or $5 million IPOs. They were tiny. They don't make it into the indexes. So it's just a very nuanced area of the market where there's not a pure way to play the speculation on both sides. I mean, you're best going long or short, just individual IPOs, individual companies.
Got you.
So great questions. Let's churn and chug along here. Biotech breakout. So it's been happening after a long biotech winter. You remember during the COVID days, the biotech indexes.
Love those days.
Stocks,
those days were so great.
They were fantastic. You could say that you took a rat into the lab and you were thinking about developing a drug and that company would go up 100%. So it was just too much money chasing after too many just science projects. We've normalized that now. The science has advanced, and a lot of these small companies that have survived have done so on the backs of really compelling data in areas of the market that are desperately needed. We're talking about just nasty forms of cancer, from pancreatic to glioblastoma in the brain to head and neck cancers that are just recurrent, metastatic. They don't go away. They resist all the drugs in the market, like Keytruda, that is, was the blockbuster before GLP-1s. The headlines are completely misleading people here, that's saying the Wall Street Journal, of all things, should know better. PhDs can't find work as Boston's biotech engine sputters. Total nonsense, right? Yeah, there was a plethora of companies that got overfunded and overvalued and now are coming back to reality. But the data and the science is good. The sentiment in the area of biotech has completely changed. The funding, more importantly, venture capital funding is happening again in the biotech space. So you're seeing all the ingredients for a prolonged biotech breakout. Again, we need to go up another 30-40% from here before you get to a new high for the XBI. And I'm telling you, it's happening because of one reason and one reason alone. Big pharma has a massive patent problem. Between now and the end of 2030, over 180 or roughly $180 billion worth of drugs that are patent protected by these big pharma companies come off patent protection. So if you go down the back of the list here, you look at Amgen, Merck, Bristol Myers Squibb, Pfizer, J&J, Gilead, Eli Lilly, Regeneron, AbbVie. Some of these companies have over 40 or 50% of their drugs coming off patent in the next, call it 3 to 4 years. There's only one way to replace that. Go buy compelling biotechs that are getting closer to having approved drugs. And I mean, to give you a magnitude of this, like look at some of these drugs, right? Merck, Keytruda, you've got things up here that account for over 50% of their revenue based upon the last year's revenue. So this is a huge, huge problem that can't be solved if they just say, you know what, guys, gosh darn it, let's spend a lot of money on development right now, and between now and the next 3 years, develop new drugs. Sorry, it doesn't work that way. This industry takes a lot longer to get through clinical trials. So the only solution to this problem is to buy your way out of it, which is going to make this, it's going to be like Jiffy Pop of M&A activity for these small cap biotech companies. So is it going to be across the board in every area? I don't think so. I still think you're going to see a preference for really compelling early data in hard to treat diseases like Parkinson's and brain cancers. And then I think it's going to be a barbell effect further down. It's going to be these companies that are in phase 2 that is applying for approval, or phase 3 that's applying for approval. So later stage that can flip into commercial drugs within the next 12 to 24 months. We've already seen a flurry of M&A activity to end the year and kick off this year. I think you're going to get more and more of it. We're going to cover those compelling individual names. So again, best way to capture some of this, XBI, right? ETF gives you exposure to 153 of the smaller and mid-cap biotechs in the market, including the biggest weighting there is in Revolution Medicine, which went up like 40 or 50% on rumors that Merck was going to acquire them around JP Morgan. But then also it's got in there a company, Halozyme Therapeutics, which I love, that's trading at 9 times earnings. So you got to get good diversification, and then we're going to keep delivering up individual biotech names for you throughout the year because there's just some really compelling data and science here. Have I followed the biotech picks from our previous guests? They're doing well. Yes, Sana, we're actually going to bring back on Jonathan Faison. We got to reach out to him to have him come and give an update. He's made some trades recently, reallocating his portfolio, but he's done really well. Remember, Jonathan's focus is on those drugs that are just starting to commercialize. So he waits. Yeah, he avoids the early stage, where I love the early stage because you can get a huge run up in there. But Jonathan is really smart. He knows what his filter is and his screen and his strategy. He sticks to it, and it works really well. We're going to bring him back on because he is a much more mature, lower risk focused, but still a lot of high growth opportunities. So Chad, appreciate you bringing that up to everyone's attention because it is 100% true. Appreciate you also not saying anything about the Lou meme coin because ain't going there, son. Ain't going there.
Lou, on the biotech front, is this true? $2.6 billion in public, basically fear of poor outcome, which is basically people have money on the sidelines of their fear of pressing the button to buy. Is that true? Or at the same time, there's $2 billion worth of, VC private financing that is investing in it.
Yeah, there's a ton of money sitting on the sidelines. There's a ton of money sitting on corporate balance sheets, the Eli Lillys of the world that can fund more than one big acquisition. So yeah, there's a lot of dry powder and a clock. Like imagine a countdown clock. It's happening. Like if you went into Eli Lilly's or Merck's headquarters, I would not be surprised if there's some employees that are going like literally have a countdown clock on when that patent on Keytruda expires. What drugs that they can pair in combination with it to try and extend some of that patent coverage. Like it's a real problem that only has one real solution. That's what we're going to try and capitalize in 2026.
All right.
So from IPOs to biotech breakouts to AI, right? Let's talk.
Next
bubble.
one, number 5, AI bubble keeps inflating.
Yeah, look, I've just given up on saying it's not a bubble. It's not a tumor. It's not a tumor, right? All right, forget it. It's a bubble. But you know what? The bubble is still early and it's still got a long ways to inflate. I've never in the history of the world seen a bubble pop when you have a supply outpacing demand. I mean, you have demand way outpacing supply. So that's just not the makings of a bubble bursting. I do believe, though, that CEO of Microsoft, Satya Nadella, had his finger on a key point where he's saying that we're exiting the discovery stage and going into the dispersion stage. For me, that resonated because basically these large language models, this was discovery. What can they do? What can the ChatGPTs of the world do? Claude, right? In the last 2 weeks, all you're hearing about now, how Claude is going to completely replace programming because you can create an agent that just codes automatically and creates software for you where you don't even need to manage it, right? You just go away, create this, and it does it. So you're seeing that the discovery of what can it do is happening. Now it's dispersion. How do you push that down into the markets to generate real solutions to real problems? If you look at the percentage of GDP spending on AI versus other huge booms, infrastructure booms, public works, Manhattan Project, electricity, interstate highways, AI is basically rivaling those, getting north of 2%. Of total GDP spending. But still, folks, I think we can get to 5% and still not be in bubble territory. So more than double from here. And you're still seeing these investments that are going to start generating profits. I mean, that was the funny thing. Do you remember the MIT headline? Because it made it into mainstream press everywhere, too, that 95% of AI investments have proven unprofitable and unworthy, right? Like that was MIT's huge conclusion, I don't know, 6 to 9 months ago, which was the equivalent of someone that went on a diet and a fitness regime for 2 days and then declared it a failure 2 days later because they didn't lose 10 pounds, right? Like it was just too early. And now what we're seeing is the latest data is coming out saying, look, these companies that are implementing AI, they've discovered what they can use it for, and now they're dispersing it throughout the system, are getting a great ROI. They're seeing huge impact positively on their businesses. You're seeing it from Microsoft to Apple to Alphabet. It's going to keep happening. So I think you got to play the AI trend in 2 ways: solutions and power, right? Because the bottleneck for AI scaling is energy. And we've had the TerraWolf CEO and CFO on. We've had Eric Jackson that talked, and Mike Alfred through IREN. I mean, here's the key chart that drives home this point. We need power. He-Man has the power. The utilities don't have the power yet, right? There's a huge demand gap here between power supply and the power needed to meet demand. So we'll keep bringing up names in that space: Cipher Mining, IREN, CoreWeave, Core Scientific. There's a whole bevy of names that you can play in that space to capitalize on that. But then also I want to put on people's radars the solution providers, right? So there's drug companies that are developing new drugs using AI. The best example I've seen of this dispersion is Lemonade. It's an insurance company, a traditionally stodgy, boring as hell industry. I got my start there right out of school, in insurance and specialty reinsurance. But Lemonade is now showing what can be done using AI. They have a partnership. They do renter's insurance, pet insurance, car insurance. They have a partnership with Tesla where they get the data feed, and they were able, based upon when full self-driving mode was engaged versus the human driver, to give people a 50% discount on their auto rates because humans suck at driving relative to the robots. And when they figured out that the mix was, hey, these humans really aren't driving as much, we can give them a discount. I think this drives home 2 points. AI is going to lead to real solutions in the real world that are going to drive down costs at a time when energy prices, food prices, real estate prices could drive up costs. So AI is the great deflator. But I think this is interesting here too. Lemonade is a company that's scaling and not adding a lot of headcount. So like if you look at how big their book of business has gotten, it's up, triple digits, revenue, profits, margins, all that, but they're not adding a lot of headcount. That's the productivity gains you get with AI. Stock's done phenomenally well here. If you look over the last 6 months, last year, just a great trade. I think it's going to be one of many AI solution providers that offer opportunities for us as investors to make a lot of money from them. And we will do our best to bring, we had our top 10 AI stocks not named NVIDIA list. We'll keep updating that. Great question here. Any thoughts on how Microsoft's earnings this week will go? Up 5.9% this past year is underwhelming to say the least. Yeah, look, Microsoft caught on fire. I mean, I tried to buy a boatload of it when it was trading at like $250. I remember being on Varney and Company because he's a longtime shareholder. And he asked me if I was finally a buyer. And I said, I wanted to see it hit close to 200. And it never got there and then just ripped from there. I do think Microsoft is in a unique position to roll out, just like Apple, better applications and solutions with AI. So I think Microsoft is going to do well. I think it's one of the AI names you have to own, just like NVIDIA. I think you need some exposure to it. But I also think Alphabet's another one. So Mag 7, as I've said, I've overused this. You get sick of it too, Dodd. Is the boy band that broke up, right? They're all on their solo.
Oh, here we go again.
Yeah, they're all on their solo.
Love boy bands.
No, I don't really. I mean, but it just works. The analogy works, right? Yeah. They're all in their solo career. So I do think that each of them, like, I don't get Meta at all. Makes no sense to me. Why does a social network need to be on cutting edge chip development? They should just do what Apple's doing. Leverage and rent and be a customer of the company that develops the best AI chips because it serves them no purpose. They're a consumer device company. Facebook is an advertising company, Meta, whatever you want to call it, right? I'm going to go back to calling it Facebook because the metaverse was a complete flop. It incinerated.
Well, you still call X Twitter.
I know. I told you I'd do that until Elon Musk followed me, and then I'd respect it. But we might be doing
I got a question for you related to this. So this week I know is a big week because for Mag 7, 4 of the Mag 7 companies report earnings. So Microsoft, Meta, Apple, and Tesla. And a lot of the smoke, for what I understand, is people wanting to see they're investing in AI a ton, but are they making money from AI? So I think that's the big indicator are their profits coming from AI going to pay off? So what's your take on what's going to happen? And I think our last guest there just asked about Microsoft.
Yeah. So I
think Meta, Apple, and Tesla. What's your take?
No, you're absolutely right. You put your finger on it. Investors have been bipolar on this. If you look at Meta's earnings reports over the last 3 or 4 quarters, at first people got really excited because they were spending on AI. Then they got really pissed off that they were overspending and you weren't seeing any return on that. And then you saw ad rates start to go up. Same thing happened with Alphabet. You saw that they were driving more growth in their cloud computing, and then also advertising was being more effective for customers. So yes, you need to see tangible results. I think the hype phase is over where we'll believe you and give you the benefit of the doubt. It's now turned into a show me story. Show me your investments translating into more growth in profits, in sales, something in margin. You have to show us something tangible that is proving out that all these massive dollar investments, capital expenditures on AI is working out. So I think, yes, Microsoft's going to show that. Alphabet is going to show that. Meta, I don't know. I question. I think that one's the most fragile and most potentially volatile on that because, they report later this week. I do think that one is the most challenged of the group right now. Tesla, I don't really see it as an AI company, which would, a lot of my peers would laugh at me for saying that. They're like, they have all these autonomous driving cars and they're going to have robots that blanket the earth and there's going to be 8 billion people and 40 billion optimists. No, there's not. They're not there yet, right? So I don't think their business, by and large, is still cars. It's automobiles, right? And about 10 to 15% is batteries and power generation. Just like I would tell you, Meta has nothing to do with AI. 98% of the revenue comes from advertising. It's an advertising company. Alphabet, largely an advertising company and a cloud computing company. So, yeah, I think Meta is the most vulnerable. I think Apple and Alphabet are the ones that are being undervalued and just discounted still too much. Microsoft and NVIDIA, I think, are just two horses you have to own. They're blue chip AI stocks.
Yeah. All right. Well, I hate to move us along, but we have a sixth prediction here we got to get to, which is predictions market pop, which boggles my mind. But go ahead.
It boggles my mind that you're allowed to gamble money on pretty much anything. Like,
well, that's my question. It feels like I look at it as gambling, and then it makes me feel like, well, the stock market technically is gambling in a way, but then it's like,
no,
I'm trying to, there's substance behind the stock market with companies that actually earn money, and then predictions, which is basically a guess an outcome.
Yes, right. So look, there's a speculative quality to stock investing, but at its core, stock and equity investing is an ownership stake in a real business that's supposed to be doing real things to create real value and real profits. The prediction markets are purely that. It's pure speculation. I mean, I feel like it's just Las Vegas casino games gone wild, right? I mean,
which now you got my ear. But
yeah, I know. But I mean, look, is Girls Gone Wild still a thing? Is that guy still around? No, like that's every fad. That video thing is just going to be just as much of a fad as prediction markets. Look at this, bet on everything. These are the new markets. Like basically you can create a market in anything and bet on it. It's ballooned to, tens of thousands in a period of time of just in a matter of years. This is what a bubble looks like. And here's the thing, people will try and tell you, and this is like monthly volume trading. We're talking about tens of billions of dollars across the three major platforms, Polymarket General and Polymarket US, and then Kalshi. But here's the thing, the supporters would tell you, well, you're just isolating very individual risk factors. And now you can bet on individual outcomes where you couldn't do that before. In the equity markets, you had to bet on the ultimate outcome, right? Do they grow earnings or not? Or as opposed to like, I wouldn't put it out. Maybe there's a bet out there right now. Does Apple come out with a new consumer device in 2026 or at the developers conference in June of this year? I bet that will be one of those things. And you can bet either side of that. I'm sure, who's going to be the next Fed chair? Jesus might make an appearance on that list now that we've gotten rid of the
talking.
Yeah.
So, I got some AI for that.
But you say, like, this is the thing. Here's why I think it's going to get blown up to smithereens is because insider trading is happening in broad daylight. You saw this with the invasion of Venezuela. Someone took about a $10,000 bet and turned it into $500,000. It's insane. And then, there's no, know your customer insider information laws like there are on Wall Street that FINRA and the SEC regulate where there's repercussions. I mean, there was rumors
Wild West, and it's legal at the moment.
At the moment, there was rumors that people were trying to pin it on that, like Barron Trump was the mystery trader here because he knows exactly what his dad's going to do next, and you know what, he could do that because there's no recourse. So I'm telling you, if the prediction market doesn't pop this year, it is going to be shortly thereafter. But we are going to hit fever pitch. I don't know the way to play this yet.
Another funny thing I noticed is, media and analysts. I just saw some, coverage this morning that includes this predictions market in their, normal kind of messaging. Yeah. So like it's being considered as part of the investment market in a way.
It's a way people are going to tell you, it's a way to measure risk and quantify appetite and, indicate variables that people aren't thinking about, and it gives you more information. It's not bad information. I'm here to tell you,
current with the times, which
speaking of but it's current with the times, we're running out of time. So I know you had a game teed up, but we're going to save that for next week.
Dude, we can save it. It'll take me a minute. It'll be great, but that's all right. We'll do it next time.
It's 5:59 and I got a meme coin to launch because at 6 o'clock sharp, I'm launching the Lou Basenese Crapanese coin. Like it's coming. Here we go. But folks, thank you for tuning in to the Big Skinny with Lou Basenese and Dodd. As we kick off the year with our big predictions, please pay attention next Monday and the Monday after that. And the Monday after that, we're going to have more to show and more to come, more information, more insights, more investing ideas.
We have something this week coming out. You want to just talk about that quickly?
No, we'll tease them. It's coming out.
We
have more predictions, more investment insights coming your way all along the way. So please make sure you subscribe on our YouTube channel, follow us on X or wherever you consume your podcasts, and we'll be back on the Big Skinny, Lou Basenese and friends and meme coins.